People feel bad negotiating with their contractor, and even worse negotiating with their insurance agent. But here's the truth. Your agent isn't your enemy, but he's definitely not your charity case either. You need to understand how the game actually works, because while you're trying to cut your operating costs and protect your rental portfolio, your insurance agent is literally building a business valuation off your premiums. This episode breaks it all down: how insurance agency commissions really work, how much value your agent gains from your renewals, and how to use that knowledge to lower your costs, increase cash flow, and protect your net worth like a real investor. Let's get into it. Expense management is wealth management. If you own real estate, you already know every dollar matters. Insurance, property taxes, maintenance, they're all silent killers of cash flow. And while investors love talking about rent growth and appreciation, the real pros obsess over expense control. Because reducing expenses by 10% increases your cash flow faster than raising rents by 10%. That's why we're talking about insurance commissions, a cost that hides in plain sight, and one that quietly grows someone else's net worth at your expense. When you pay your annual property insurance premium, let's say it's $5,000 for a small multifamily, your insurance agent typically earns 10 to 15% commission on that policy. That's $500 to $750 straight to the agent every year. And here's the key part. It's not a one-time deal. Every renewal, that agent gets another 10 to 15% of the full premium. If you own 5 rentals with combined premiums of $25,000 a year, your agent's making between $2,500 and $3,700 annually, just from your portfolio. And if you never shop around, that's recurring income for them, locked in. Insurance agencies don't just make money from those commissions. They build enterprise value off that recurring revenue. When an agency sells, buyers, usually private equity firms, pay around 2.5 to 3.5 times annual commissions. So every dollar your agent earns from you adds roughly $3 to the value of their business. Your $25,000 premium might be worth $75,000 in their exit valuation. You're literally compounding their wealth with your operating expense. Now let's look at it from your side. If you save $7,500 a year by shopping and optimizing coverage, that savings drops straight to your NOI. At a 10 times NOI multiple, which is common for small multifamily portfolios, that single move adds $75,000 of value to your properties. So here's the comparison. You either fund your agent's 3 times commission multiple, or you multiply your own NOI savings by 10. Which side of that equation would you rather be on? Because one grows his valuation, the other grows yours. Now, this doesn't mean agents shouldn't make money. They should. They provide a service, handle renewals, and help with claims. But you're not rewarded for loyalty. You're penalized for it. Carriers know most landlords never shop their policies. They renew automatically, ignore rate hikes, and never compare coverage. So premiums creep higher, 5% this year, 7% next year, and your agent's commission rises right along with it. That's the misalignment. Your costs go up, their income goes up, and their agency valuation keeps compounding. You're building someone else's asset with your expenses. Smart investors treat insurance like any other negotiable line item in their P&L. They don't feel bad asking for quotes, and they don't apologize for demanding competitive rates. Every dollar you save goes straight to net operating income and directly increases your property value. You're not just saving money, you're creating equity. A couple years ago, I reviewed my landlord insurance. 5 properties, $25,000 a year in premiums. My agent was earning about 12%, roughly $3,000 annually from my account. I requested new quotes and found equivalent coverage for 30% less, saving $7,500 a year. That's $7,500 I stopped donating to someone else's valuation. It now compounds mine instead. Here's a professional level move most small landlords don't know about: hiring a fee-only insurance consultant. This isn't a broker or agent. It's a flat-fee insurance advisor who represents you only. Think of them as your risk manager or loss control expert. They oversee your brokers, review policies, flag coverage gaps, and ensure everything is written for investor protection, not agency profit. When your broker's commission depends on your premium, They're not motivated to find the absolute lowest price. A consultant flips that incentive. You pay them a flat fee, and their job is to reduce your total spend while improving coverage. They identify where you're overinsured, underdeducted, or misclassified in risk. Large real estate funds use these consultants all the time, and it saves them tens of thousands annually. If you're insuring more than $10,000 a year in premiums, you should seriously consider adding one. They don't sell policies, they manage risk, and they work for you, not the middlemen. Now back to the agency economics. Private equity firms love insurance agencies because they're recurring revenue machines, high retention, predictable renewals, huge margins. Most operate at 40 to 50% EBITDA and sell for 8 to 12 times earnings. So when your agent sells his book, he's getting paid up front for years of your renewals, yours included. You're part of his exit valuation. Once you realize that, it's easier to say, this is business. I'm shopping around. And you should. Here's how to do it right. Step 1, request commission disclosure. Step 2, shop every 24 months. Step 3, separate emotion from economics. Step 4, bundle smart with portfolio umbrellas. Step 5, reinvest the savings into upgrades, reserves, or debt paydown. You can also raise deductibles strategically, improve risk profile through maintenance, and get multiple quotes from independents. These moves can save thousands each year, directly boosting NOI. Every business model has incentives. Your agent's incentive is renewals. Yours is profitability. When you understand that, you start managing relationships differently. You don't need to hate your agent. You just need to act like a CEO. A CEO doesn't apologize for protecting margins. You're running a business. Don't fund someone else's valuation when that money could be compounding your own. Be loyal to your numbers, not your feelings. That's how you build financial freedom, by owning assets, controlling expenses, and understanding every line item in your operation. Because the moment you stop feeling bad for negotiating, you start feeling good about your balance sheet. If you want help setting up an insurance review or connecting with a fee-based consultant who can oversee your brokers and policies, contact me on Instagram or Facebook. I'll point you in the right direction and show you how to turn insurance into a wealth protection strategy, not a hidden expense. Follow the Finance Shark for more real estate investing breakdowns, cash flow strategies, and financial freedom frameworks. Because in this game, it's not just about what you earn, it's about what you keep.